Artificial intelligence is changing, and it's forcing a rethink of how money is managed. Over decades, one of the most reliable strategies has been investing in an S&P 500 index fund. It's simple, consistent, and historically delivers around 10% per year. Instead of trying to pick individual winners, this approach spreads money across the largest companies in the United States. Some rise, some fall, but over time, the overall market tends to grow. However, a closer look reveals something most people overlook. A significant portion of that investment is heavily concentrated in just a few companies. In fact, roughly 40% of the money can end up in only 10 stocks. One company alone can take a surprisingly large share simply because of its size. This happens because the index is weighted by market value. The larger a company becomes, the more investment it attracts automatically. So the real question is, why are these companies becoming so dominant? When broken down, many of them share one common factor. They are all investing aggressively into artificial intelligence. At first glance, that seems logical. AI is widely seen as the future. But a deeper look raises concerns. For these companies to justify their current valuations, they would need to generate enormous levels of future revenue, far beyond what they produce today. This means prices are driven more by expectations than by current performance. This creates a powerful feedback loop. As these companies grow, more money flows into them through index funds. That pushes their valuations even higher, increasing their share of the index, which then attracts even more investment. It's a self-reinforcing cycle, but one that depends heavily on future expectations being met. Because of this, relying entirely on one market introduces risk. History has shown that no country remains dominant forever. There have been periods where different economies appeared unstoppable, only for leadership to shift over time. Markets evolve, and assumptions can quickly become outdated. This leads to a broader perspective on opportunity. The market can be viewed in different segments. There are large, crowded companies where most capital is already concentrated. There are stable businesses that perform consistently regardless of economic conditions. There are speculative companies driven by hype. And then there is a less obvious category, the overlooked group. This overlooked segment is where new opportunities often emerge. While major corporations spend billions developing advanced AI systems, smaller and mid-sized businesses are focusing on applying these tools in practical ways. Instead of trying to dominate the technology, they are using it to improve efficiency and solve real problems. As AI continues to develop, many models are becoming similar in capability. This shifts the advantage. It may not go to the companies building the technology, but to those using it most effectively. When a technology becomes widely accessible and good enough, value often moves away from creators and towards those who apply it intelligently. At the same time, technological shifts introduce uncertainty. When uncertainty increases, capital often moves towards stability. Throughout history, assets like gold have been used as a form of protection during periods of change. Rather than making extreme adjustments, a more balanced approach can be taken. Allocating a small portion of capital into more stable assets provides a layer of protection while maintaining flexibility. Another often overlooked element is cash. While it may not generate high returns, it creates opportunity. When markets decline, and they always do at some point, having available cash allows for action. It provides the ability to take advantage of opportunities while others are constrained. The overall approach remains straightforward. Continue investing in broad market funds while gradually expanding into global markets, smaller companies, and a mix of stable assets. This creates a more balanced and adaptable portfolio. Because the reality is simple. No one can predict exactly what will happen next. Markets shift, Technologies evolve and leadership changes over time. Instead of relying on a single outcome, preparation across multiple scenarios becomes the stronger strategy. In the end, long-term success is not about being right once. It's about staying consistent, adapting when necessary, and remaining in a position to benefit from future opportunities.